Thank you everyone for joining today's webinar, Marketplace Lending Insights, Trends, and the Road Ahead for 2025. We're really excited to have our partners from Chapman share updates that they actually launched at our policy summit in November. But if you were unable to join us at the summit or tune into their roundtable, you'll get a deep dive into that today. So really looking forward to it. Marc and Tobias, I will turn it over to you.
Great. Thanks, Taylor, and thanks to the American FinTech Council for this. As many of you know, Chapman and Cutler puts out a publication, which I don't know if you can see or not, but it's called The Regulation of Marketplace Lending. We've been doing this for several years, and it serves as both a historical compilation of things that have gone on in the marketplace lending space, as well as a compilation of current events that have happened since the last publication. And as Taylor said, we put out the newest edition, which I think is our 14th edition, in November at the AFC Policy Summit. If any of you would like an electronic copy of this, it is available on our website, chapman.com, and it will link you to that publication, The Regulation of Marketplace Lending. So what we'd like to try to do today is to both review a little bit of the things that have happened over the course of this last year. And then, as everyone is sort of doing, I think, looking into their crystal ball and trying to figure out what the next year or so is, in fact, going to bring. And if you've noticed, the CFPB continues to be putting things out on a daily basis. Something just came out this afternoon about how mortgage companies are making it difficult for divorced and deceased borrowers. You may have seen that just yesterday, the United States Supreme Court refused to grant the writ of certiorari that had been filed by the group of securitization trusts in the student lending case that was on appeal from the Third Circuit, finding that securitization vehicles are covered persons under the Consumer Financial Protection Act. So that very hot off the press and will affect programs that have securitization in place and making those trusts and special purpose vehicles covered persons for purposes of the consumer protection laws. So I just like to sort of go into 3 or 4 different areas, and then I'll turn it over to Tobias to look at some issues and some of the things that are going on with respect to innovative products. But there have been 3 or 4 things happening over the course of the last year or so. Obviously, one dealing with federal preemption and what's going on in Colorado, and many of you have been involved with that. Also, state law activities that affect marketplace programs, enforcement actions that have in particular targeted marketplace lending programs, and proposed regulations aimed at least in part, at some of the things that are happening in this particular space. So first off, preemption. Preemption has, while it's been a foundation of particularly the partner bank programs that are in existence, which are most of the marketplace programs, it's also been a point of contention. And while national banks have unfettered federal preemption to export their rates and fees nationwide, state banks have a similar preemption, other than the fact that states have the right to opt out of federal preemption. And when that law was passed in the early 80s, some states did opt out, many states opted back in, and at the current point in time, only Iowa and Puerto Rico have opt-outs that are effective. And the one in particular that we're going to spend some time on here has to do with what's going on in Colorado, which, as many of you know, enacted a little over a year ago a law to opt out of federal preemption, attempting to stop, in their view, predatory lending practices, even though it wouldn't affect national banks and wouldn't affect many of the programs in that particular state. The opt-out was supposed to go into effect in July of this year, but was challenged by the AFC and others in court. And the law was actually enjoined by the district court there in Colorado and is now on appeal to the 10th Circuit. But what is really interesting about this particular situation is that perhaps there will be a decision that tells us just exactly what does it mean when one opts out of federal preemption. Because the law essentially says that an opt-out deals with loans made in that state. And so then the question becomes, where is a loan made? And in the Colorado situation, the state is alleging that the loan is made in the place where the borrower resides. Or they've waffled a little bit and said where it's either where the borrower is or where the bank is, which of course is an unworkable type of scenario because it could potentially involve the laws of two states. So which one really takes effect? On the other hand, the trade associations, including the AFC, which are challenging this law, essentially contend that a loan is made in the state where the bank is located, where the bank performs, as the FDIC has stated over time, where the non-ministerial functions in connection with the loan are made, where the credit underwriting decision is made, where the decision is communicated to the borrower, and where the funds are dispersed, which typically is the place where the bank is located. And the preliminary injunction that was granted essentially adopted that position and said, indeed, a loan really is made where the bank is doing all of their work and where it is located. Although the FDIC, in contrary to other cases in which it's filed amicus briefs, changed its position on where a loan is made and actually backed the state of Colorado. So we shall see how that appeal really comes out, but we may actually get some guidance on where loans are actually made of sort of a definitive nature. And certainly kudos to AFC and the other trade associations which are challenging, that particular opt-out right, which had the potential of going into other states. Other states were considering that type of legislation. We're just getting ready to kick off the new legislative session here at the beginning of the new year, and we shall see if states are going to try to copycat that or not, or whether they will be deterred by virtue of the fact that this litigation is out there and either not want to fight it and spend the money to do that, or wait until a decision comes out on that. So more to come on that. We've also seen several laws come into effect over the last few years that have the potential of trying to impact the service providers that assist banks and service marketplace loans and oftentimes purchase marketplace loans. Beginning in 2021, in the state where I reside, Illinois, or the People's Republic of Illinois, as some of us call it, was the first state to pass a law aimed at marketplace lenders, and essentially saying that whoever acquires the predominant economic interest in a loan above 36% makes the loan void and subject to penalties. There are anti-evasion provisions and other aspects to try to determine whether or not the service provider is in fact engaging in those activities so as to be subject to that particular law. Other states followed: Maine, Hawaii, New Mexico, Nebraska, and really in 2024, Minnesota, with respect to small loans that probably don't impact a huge segment of the industry, and Washington as well. And beginning on January 1st of 2025, Wisconsin has enacted a law that will require registration as a consumer lender if one is taking assignment of loans above 18%. So a new licensing requirement, if you will. And Tobias a little bit later is going to talk about some licensing issues, and we'll sort of highlight that. What really becomes sort of amazing to me is that despite the fact that these laws are on the books, as of yet, I have neither seen any action of enforcement under those laws or any challenges to the constitutionality of those particular laws. And the other thing that we see again affecting securitizations, I just read an offering memorandum yesterday for a consumer product, and so many of these states are getting excluded from securitizations because of these types of laws that are on the books. And so it's cutting back into the pools of receivables that are being able to be financed. So certainly does have some impact with respect to the industry. The other thing that we're seeing in terms of state legislation is on the commercial side. As many of you know, California and then New York enacted commercial disclosure laws for certain types of commercial loans, merchant cash advances, financing leases, other forms of lending types of products. That has now proliferated into several states: Utah, Virginia, Florida, Connecticut, Kansas, Missouri. And while some of these laws are very similar, they're also different. And certainly as to the marketplace lenders in the business financing realm, this imposes additional responsibilities, compliance, and potential liability with respect to those disclosure requirements. So again, we anticipate in 2025 that we'll be seeing more of those commercial disclosure legislation being introduced and pending. There were several that died in the last legislative session, but likely to rear its head again. Got several things that have happened on the enforcement side. Again, most of you recognize and understand that in June of 2023, the banking agencies enacted interagency guidance on third-party risk management, bringing together all of the agencies under one umbrella, took a life cycle approach to that regulation, planning for working with third parties, diligencing third parties, contracting with third parties, monitoring third parties, and even terminating third parties, and equivocally stated that this is the responsibility of the banks that work with these third parties, and as well that those third parties can be subject to supervision and examination by the banking agency as well. And as is the case, oftentimes when we get guidance, supervision and enforcement often follows, and this happened. Several enforcement actions over the course of 2024. Many of them on bank secrecy and anti-money laundering issues, some of them on fair lending issues, some of them on consumers' access to funds, but many of them focused in on the fintechs programs that are working with those insured depository institutions. Starting in January, for instance, Blue Ridge Bank, which was a national bank and a player in the marketplace space, got cited for BSA violations, and in particular, lack of suspicious activity reporting, and required a look back for a lot of those particular programs. And as a result, Blue Ridge didn't engage in additional marketplace programs, and in fact shed itself of some of its particular programs. Lineage Bank, another bank, had an enforcement action in January of this year. In February, Sutton Bank, which is a big player, particularly on the prepaid and debit part of the industry, also on BSA matters, and the bank was required to beef up its BSA compliance, hire a full-time BSA officer, and have additional board insight. Again, in February, Piermont Bank in New York, lack of internal controls and information systems with respect to third parties. This is a big thing with the regulators, that they want to have access to information, and they want the bank to have access to information about those third-party programs. And some of those programs are just not meeting those particular standards. But it certainly is a recurring theme that the regulators want information to assess compliance that needs to be at the bank level, and the bank needs to get it from its third-party providers. And probably the most famous one that most of us are familiar with, the Federal Reserve entered into an enforcement, actually a cease and desist order with Evolve Bank and Trust in June, based upon the activities of a middleware provider called Synapse, who in essence provides FBO accounts and other places where consumers park their funds in part of the transactions of some of these marketplace programs. And Synapse was failing, eventually went into bankruptcy, and the customers were unable to access their funds, and hence the regulatory order in terms of this. It's a matter which is still being worked out. Some consumers still don't have their funds. Lawsuits have been filed over this particular type of thing. And what was sort of interesting, at least in my knowledge, there was a new requirement added in that cease and desist order, that the bank needed to engage in an impact analysis where there was going to be a termination of any program. So sort of on a proactive basis, sponsor banks, funding banks need to do an analysis of what would happen to the bank, what risks, what consequences if a program ended up failing, and how will the bank handle the departure of those particular programs. So some interesting things actually coming out of some of those enforcement actions. And again, other banks have been examined, are under scrutiny, and depending on what happens with the changes at the federal agencies, likely perhaps to see some additional ones with respect to these third-party programs. Sort of as a consequence of the Synapse bankruptcy situation, a couple of proposed rules have come down. One on brokered deposits by the FDIC, even though they had revamped this regulation just a year and a half or 2 years ago. They're calling to do it again, to expand the definition of what a deposit broker is. It's being challenged by trade groups, and certainly there is some hope that the rule will be withdrawn given the change of administrations next year. Also, as a result of the Synapse situation, the FDIC promulgated a rule on FBO custodial accounts, and in essence are going to, if the rule goes into effect, impose record-keeping requirements upon the banks that the bank will need to have access to and know at the end of every business day just exactly what funds every customer has. Again, part of the problem with Synapse is they had that information. It wasn't necessarily correct. The banks didn't have that information, couldn't reconcile those particular accounts. This proposed rule would impact those particular kinds of programs. The FDIC has also proposed a rule with respect to industrial banks, which affects some programs based in Utah, that would provide for greater supervision over the parent companies of industrial banks, and also impose requirements that those banks be able to operate even without being the captive of the parent. So again, some of these new rules are maybe in a state of flux and might be withdrawn, might not ever become effective, but they are certainly out there as well. And we know that, of course, the CFPB is examining non-banks, as well as has started its non-bank registry of offenders of consumer protection laws. And so those things are happening at the current point in time as well. Just like to take a minute to look at litigation. I know oftentimes we talk about regulatory things, but there's also some things happening on the litigation front that are significant. There have been several cases out there, oftentimes many of them against high rate lenders, subprime lenders, but they all sort of follow the same pattern. The plaintiffs tend to sue in state court because they think that's a good or better venue. They typically don't sue the sponsor banks in a bank partner program. They only sue the fintech. Typically then the fintech removes the action to federal court and files a motion to compel arbitration, because most consumer financial loan agreements have arbitration agreements in them. And then if granted, it goes to arbitration and thus avoids not only class action status, but results in settlement. And this has happened time and time again over the past year in several different situations. One area of note is that California, of course, being the largest state in the union, has some interesting laws with respect to arbitrations, and that the law in California says that you must be able to bring a public injunction. So oftentimes arbitration clauses, at least in California, say you can still bring public injunctions, but other than that, everything has to go to arbitration. And recently in a marketplace lending case out in California, a case called Carpenter versus Opportunity Financial, the Ninth Circuit actually said, yes, arbitration is good, and sent it back to the lower court to compel arbitration. That defendant, Opportunity Financial, is also engaged in litigation with the state of California over the legality of bank partnership programs. And again, even though it is a high rate lender, the state had threatened an enforcement action, and offensively, Opportunity Financial sued the state, requesting a declaratory judgment that marketplace programs are good, that the bank is the lender and not the fintech. The state, of course, issued several salvos against them, and ultimately the state sought an injunction against them making any additional loans in the state, which the court denied, and essentially said that, or was a precursor to a decision that they would probably make, that the state had not shown that it would prevail on the merits, thus suggesting that the bank partnership model is in fact valid there, because bank funds were used to fund the particular loans, and in that case the bank continued to own the loan itself and an economic interest in the loan. It was a participation type of arrangement. That case is now in the throes of discovery, so it may be some time before we actually see what happens. But again, as of right now, the tea leaves are looking good on that particular situation. There was a similar case in Oregon, a company called Loan Mart. Again, the state threatened an enforcement action against the online auto lender, and was going to void those particular loans. The fintech sued the regulator, again seeking declaratory relief that the bank was in fact the true lender. Interestingly enough, the state keeps renewing their lending license of the company, and so that still is one to watch at this particular point in time. And so in a minute, I'm going to turn this over to Tobias, but part of what we want to try to do is project perhaps what's going to happen. Um, Certainly, we've seen more litigation, I think, in this past year, which probably is going to continue, particularly if things on the regulatory side become cooler, if you will, or not quite as extensive as they have been in the past. We obviously will have some changes at the federal regulatory agency. We're all looking to see what those particular things are going to be. We can certainly bet that probably Rohit Chopra, the head of the CFPB, is not going to step down prior to the new administration coming into being. So Donald Trump will be able to go back into his apprentice show mode and say, "You're fired." And most likely happens, but who knows at what point that may happen. There's some signals, at least if you are watching the appointments being made, that the financial arena may not be at the top of that particular list. People seem to think that enforcement is going to go down. I'm not so sure about that. A study was recently put out saying that in her first year, Kathy Kraninger, who was Trump's appointee to head the CFPB, had 2 times the number of enforcement actions than Rohit Chopra did in his first year. They tended not to have as deep a penalties as the Chopra CFPB imposes, but it suggests that enforcement probably is certainly not going to stop. It may not even slow, but it may be more focused on true violations. The other thing, of course, is that people are watching to see what rules will be paused, what rules might be rolled back, like the credit card late fee rule, for instance. And there may actually be some consensus. Recently, a bipartisan bill, that's unusual these days, a bipartisan bill, was introduced in Congress to limit the investigatory powers of the CFPB, require a cost-benefit analysis of engaging in an investigation prior to doing it. So we'll see what happens there. And in an aftermath of the Supreme Court ruling this past May, will there be changes to the funding structure, making the CFPB subject to congressional appropriation? Will there be changes to its leadership structure? Although, again, there are those folks asking for dismantling of the agency. That probably, since it requires 60 votes in Congress, the Senate to do that, it probably is unlikely to happen. But your guess is as good as mine. But it's going to be interesting to see how things pan out, particularly as it will affect the marketplace space. So with that, I'm going to turn it over to Tobias, who's going to talk about some innovative product issues and some licensing issues, which are important as well. So Tobias.
All right. Thanks, Mark. And I apologize to everyone. I have a little bit of an allergy situation going on here, so my voice is a little more annoying than even it is normally. As Mark mentioned, I'm going to talk a little bit about some hot licensing issues and then get into regulation of innovative products, specifically the earned wage access or EWA, and then buy now, pay later. So first, let's talk about licensing. And when you generally hear licensing as a fintech or in a bank partnership, you usually are focused on fintech licensing, which we're certainly going to hit. But I'm going to start with something a little bit different, which is there are actually some bank-related licensing requirements, and there was actually some different types of, I want to say, movement in this space in 2024. So generally, when we look at licensing for banks, there are things like UCCC states, the Uniform Consumer Credit states that have notifications. There's some weird registration requirement in Oklahoma, but we're not going to really talk about those because those have been around forever and have been on the books. What we're going to focus on is Oregon and Maryland. And so for those of you who don't know, the Oregon Consumer Finance Act has a provision that effectively says if you are an entity that you're either operating under the laws of the United States or the state of Oregon relating to lending money or extending credit, basically that act doesn't apply to you. So among other things, that act has a licensing requirement. And the interesting thing about the Oregon Consumer Finance Act is, unlike many other of its peer states that have similar statutes, there is no express exemption for a state chartered bank. And just as a little refresher on preemption, national banks have licensing preemption, but state banks don't. So that's why this is kind of a hot topic and relevant. So the old view used to be that that language, again, if you are operating under the laws of the United States or the state of Oregon related to lending money or extending credit, the statute didn't apply. That applied equally to both national banks and state charter banks under the theory that these institutions were regulated under the Federal Deposit FDIA Act, and then also just that they were also potentially regulated by the Federal Reserve if you were a state charter bank. Well, sometime within the last couple of years, Oregon has changed its view on this and is really saying that the statute really only doesn't apply to national banks. And we've seen a couple of different contexts where this comes up. The first one is if a fintech applies for a license. As many of you may know, there is an argument that there's broker licensing requirements in Oregon and servicing. And the first question that they ask is, what type of bank are you engaged in your relationship? And if it's a state chartered bank, they will tell you typically to find another bank or some entity that is not a bank but is also licensed in Oregon. The other place that's coming up more frequently now is on examinations. And we've seen things like the regulator asking for documents, which of course is relatively, there's not much harm in providing those documents, but it's just unclear exactly where they're going to take this, but it's something to keep your eye on. And we'll talk about the consequences of getting the license if you are a state charter bank. We have talked to a few banks who are contemplating that in a second, because it also equally applies in Maryland. But this is a growing area, and I think it's really an offshoot of, well, the states want to try to figure out how to potentially regulate the marketplace relationship in an even greater way, as opposed to just the fintechs themselves. So in Maryland, there was the Bank of Missouri Fortiva financial matter that was settled recently. And again, in our book, we have a write-up on this. And if you look at that issue, what was going on was none of the entities were licensed. And the Bank of Missouri, actually elected to make its loans pursuant to the Maryland interest and usury statute, which is actually, if you think about your own relationships with your banks, or if you are a bank, how you handle this in your loan agreements with your fintechs, usually what we see is some sort of election into either the open-end credit grantor provisions, which is Subtitle 9 of Maryland commercial laws, or the closed-end credit grantor provisions, which are Subtitle 10. The issue with that is the way it works in Maryland is if you make that election, the bank itself has to have an installment loan license. If you read the statute, that's pretty clear. But on the other hand, if there is no election and you make the loan pursuant to either the consumer lender law in Maryland or the Maryland interest and usury provisions, then no license is required, because literally the statute says that the regulator cannot issue the license to a bank. So in this matter, how it ultimately got resolved was there was a entity that was engaging in brokering activities and an entity that was engaging in collection activities, all separate from the bank. And what the regulator ultimately said was the bank didn't need a license. But again, remember, that's consistent with what you would expect, because it elected to make the loans under the less, I guess the best way to think about it is less modern statute of the consumer lender law. They elected to make the law under the interest provisions. So there was no license required for the bank, and there was collection related licenses for the entity that was actually collecting on the credit card receivables. So the other piece to this that is interesting is if you do elect to make your loans in Maryland pursuant to the consumer lender or loan law, what you have to bear in mind is it's a pretty outdated statute. So as a simple example, the statute requires you to provide verbatim cut and paste of particular statutes that apply and are protections for consumer protections. That includes things like the maximum rate of interest that you can charge on a loan, the fees, how you can collect those fees, and any sort of insurance related provisions. Not to mention there's different disclosures of APR that are required, et cetera. So it's a very, very onerous and outdated statute, which is why many lenders elect to make their loans pursuant to either the closed or open-end credit grantor provisions. But again, if you do that, you need an installment loan license. So this gets us back to kind of my original point, which is, what kind of considerations should banks have to the extent that they are, doing business in Maryland or Oregon? Because as a result of these requirements, I think there have been many banks that have just cut off lending in those states. So I think the first point that you want to check out if you're actually contemplating what to do in these states is try to get an understanding of what is the state's view on interest rate exportation. And I think in that regard, both Maryland and Oregon have at least signaled that they're not questioning interest rate exportation, although I will say that there was some rumors at one point that Oregon was actually trying to follow Colorado in opting out of federal interest rate preemption, but that never got anywhere. So there's that piece to it. But then the other bigger piece is, and this is a consideration that many of our banks that we've talked to ultimately decide not to do anything in either of these states, is because then you're granting the state regulatory authority over for sure the loans and potentially more holistically even over the bank itself. So many of our bank partners that we've talked to that are in marketplace arrangements have ultimately opted to just kill all lending activity in these states. So it's just something to keep an eye on. I think Maryland's a little bit more settled than Oregon. I think Oregon is still evolving, but it's something to keep an eye on both for the fintechs and also the banks. And even if just the fintechs are on the call, I think the other key is just making sure that your bank is aware of these issues. We have found that many times the banks don't always know about this because it's really what the states are trying to do is regulate these relationships through the fintech. So just keeping your banks abreast of everything that's happening in these states as well is kind of paramount. So I'm going to pivot a little bit now into kind of more directly related licensing issues, as Marc mentioned, in a couple of different states that have had some kind of updates. And so the first thing is Marc mentioned, obviously, some of the predominant economic interest states. And those, I think, if, putting my crystal hat on here for a minute, in terms of predictions, I think those are going to be the states really that those statutes kind of get followed going forward. So what they say, as Marc mentioned, is if it is determined that the fintech or the service provider to an exempt entity, is how the statutes typically phrase it, in somehow either purchase the predominant economic interest or the totality of the circumstances indicates that the service provider is really the lender, then you need to have a license. And that's a very important consideration because, as we'll see in some of these states that we're going to talk about in a second here, that leads to things like you can't broker loans or service loans above the state's otherwise limitation on the interest rates or APRs in that state. So even though your bank might be able to go up to 36% or 30% for anyone who's in a relationship with Cross River, it would mean that you couldn't broker that loan to the bank, or you couldn't service that loan if you purchased either the receivable or the loan. So it has all sorts of wide-reaching ramifications. I think those statutes are really going to serve as the model, and we're seeing a little bit of a morph on that front that we'll get to in the state of Washington. But want to talk about a couple of others before we get to Washington. So the first one was the North Carolina Consumer Finance Act. So at some point, North Carolina amended its licensing requirements to include loan servicing. When the statute first came out, I think the regulator informally told us and many of our clients that if you were a servicer, you needed to have a license. That has changed recently. We've had a couple of fintechs who have applied for licenses, and it seems that the regulator is really changed its view and is now of the mind that you don't need the servicing license if you are just servicing loans that were originated and funded by an exempt entity such as a state chartered bank. And the language that the regulator seems to be kind of clamping onto, which is the argument I think that industry lawyers like Marc and myself have always made, is the bank originated loans are not made pursuant to the act. And if you look at the language, it says something like to service consumer loans made pursuant to the act. So that's the language I think that gets you out. Now, I will tell you that in many other states, Nebraska and a few others, that view doesn't carry the day. I think other regulators think of it differently, but at least in North Carolina, they view it in the way that I think many of the industry lawyers have over the years. The next change is in Ohio, which, as you guys may know, Ohio has 4 different potential statutes that applied, and this one is specific. This analysis is specific to the Small Loan Act. And what the regulator has recently said and come out with some formal guidance, if anyone doesn't have it, let me know or let Marc know, and we can certainly forward it to you. But what the regulator has effectively said is you need a Small Loan Act license to broker loans of $5,000 or less. So a couple of key considerations here for this statute to bear in mind. Number one is it does apply both to open and closed end statutes or loans, sorry. So if you're doing just credit cards, it would still apply to you, and if you're doing closed end, it would also apply to you. The other key consideration is that this statute, and it goes to kind of what I was talking about earlier, has other sorts of ramifications that you need to be cognizant of. So the first is that the statute doesn't allow for loans of $1,000 or less. So in informal conversations with the regulators, they're saying that you would have to follow that even in like a credit card context. The second thing is the statute doesn't allow for loans with durations of less than a year. Now, that's another provision that potentially could apply to any type of arrangement with your bank partner, even if you're doing credit cards. So this is an example of what I was mentioning earlier, where the license applies, yes, but also what the regulator is saying is you have to also adhere to these types of provisions, even though it is ultimately a bank originated and funded loan. Now, the other big piece to this, and this is the main issue I think that people have with the Ohio statute, is that you cannot broker loans that exceed either 25% APR or 28% on the first 1,000 and then 22 on the remaining balance that exceeds 1,000. So again, it's a way for the state to attempt to regulate the loan activity that the banks are engaging in, even though the state isn't necessarily, and in this case, arguing that the bank doesn't have the authority to export its rates. It's just saying, well, you as a licensee don't have the ability to broker loans that exceed those rates. And the language that is the key is that there's a provision that when it talks about when the license is required, it says that the service provider receives a fee or any manner of compensation for arranging or offering to find or arrange a loan for a consumer. So it's a pretty broad kind of catch for fintechs. And most of the time, what we have seen is the fintechs don't necessarily directly get compensation from the consumers, right? The origination fees, et cetera, will typically go to the banks, but they might get any other manner of compensation. So what does that mean? We're not really sure. but it could be a fee from, we've seen fintech arrangements, right, where the bank pays the fintech a per loan basis for brokering. It could include servicing compensation, because that is certainly any other manner of compensation. There's lots of questions. And Ohio, unfortunately, has issued just basically a 2-paragraph or 1-paragraph blurb on this. And they issued it in conjunction with the fact that it is NMLS renewal season. So the whole idea, I think, was you should know about this view that Ohio has while you're doing your renewals, and strongly contemplate getting the license while you're doing those renewals. The other state that I want to mention pretty fast here is Washington. And, as we mentioned, the predominant economic interest statutes typically go down the way of whoever owns the predominant economic interest, or the totality of the circumstances indicate that. Washington has a slightly different spin on that. What it says is, if the loan exceeds 25%, then the service provider is a lender and needs a license if that service provider holds the predominant economic interest, or again, the totality of the circumstances indicate that. That's a little bit different than the other predominant economic interest statutes, because the other predominant economic interest statutes really just focus on who owns that predominant economic interest and what do the totality of the circumstances indicate. So the Washington statute, I think, drives it more off the interest rate. And again, I think that and Ohio are good examples of where the state statutes are going with regard to licensing, and how things are going to be changing maybe in the future. I think those statutes will become models. There haven't been any challenges, to the best of my knowledge right now, on any of these statutes. So it'll be interesting to see how other states kind of pivot and adapt. And then last but not least, and to just kind of clarify what Marc was saying, is Wisconsin does have a licensing requirement for loans of $25,000 or less with an APR that exceeds 18%. That's on the books already. But what's expanding is you're now going to need that license to take assignment of loans, or to service and enforce rights against consumers who have loans that meet that criteria. So 25 grand or less with an APR exceeding 18%. So if you haven't applied for that, you probably should do that while you're doing your NMLS renewals as well. So next thing I want to talk about is 2 kind of innovative products. And I think what you're going to see in both instances is that these are both products that originally the CFPB seemed to support, and deemed that there was, they were not regulated by Reg Z and TILA, and now have backpedaled. And I think what it's indicating is that there are definitely a little bit more skepticism coming from Washington on some of these products. And so just be cognizant of that if you're engaging in these products, but also just make sure you stay abreast on everything that's happening on this front with both the CFPB, and then also we'll talk about some state consequences. So the first is Earned Wage Access, or EWA. And what it basically is a product where consumers will get some sort of advance on their payroll through money that they've already earned from their jobs, but hasn't actually been paid to them. And just to be clear, this is not a payday loan, because there's no wage assignment. These are actual funds that the consumer has already earned and is basically pledging, and typically pays back within a week to 3 weeks. And it's just one payment that they would pay it back in. And so historically, there's been 2 models for EWA. One is the employee sponsored model. That's where the EWA provider partners with the employers and works and offers it only to individuals who are employed by certain employers. So it's more of a closed-end universe. The other is direct to consumers, where any consumer could get it as long as the consumer's payroll provider has a relationship with the EWA provider. So the historical view, and it was really driven off, there was a company called PayActive, which asked the CFPB for kind of a special order or special status that said that it wasn't issuing credit, and accordingly Reg Z and TILA didn't apply, as opposed and including all the other federal regulatory requirements like adverse action notices, et cetera, didn't apply. And the reason they were making that argument was there was no credit bureau reporting on these products. There was no credit bureau reporting. There was one payment, and also there was no recourse if the consumer didn't pay. So the only recourse was the EWA provider was out of the money that they advanced. So in 2020 of December, PayActive got a special order. That order got rescinded in June 30th, 2022. CFPB had mentioned to PayActive it was thinking about rescinding it, and PayActive asked to have it rescinded, largely because PayActive wanted to make particular changes to it, and the way it was originally ordered was it was very specific to the facts and circumstances that was laid out in PayActive's request. So then just over the summer in July, the CFPB issued a proposed rule, and the proposed rule basically deems EWA products credit, which means then there's TILA and Reg Z impacts for disclosures and finance charges. One of the other big things that was associated with EWA products were, as you can hopefully see, there's no interest. I should have mentioned there were no interest rates or fees typically associated with EWA, except for people would pay a tip to the provider for good service, or there's expedited delivery fees. And those, as you guys may know, aren't treated as finance charges under Reg Z, and also Reg Z isn't implicated, because in order to implicate Reg Z, there has to either be a finance charge, or the obligation has to be payable in 4 or more installments. So these products were designed in a way to avoid triggering Reg Z, because it was one payment and there were no finance charges. Because the reason tips aren't considered a finance charge is, and it's the same for expedited delivery fees, is because that's a voluntary action the consumer has to take. So unlike other products where you have to do certain things and you have to pay certain fees, that would be a finance charge. So under the proposed rule, what it says is that notwithstanding that tips and expedited delivery fees are in fact more along the lines of they are a finance charge, and the logic is that they're payable by the consumer, and it is incident to the extension of credit because it doesn't arise but for the EWA extension. So again, this is proposed, so you may want to keep your eye on that, see where it heads out. And then the last thing I want to quickly talk about is buy now, pay later. So this is classic layaway types of programs, except the difference is it's a modern spin, and in the sense that the difference now is consumers actually get the products now and pay for it later. So they will order something off Amazon, go on and say, I'd like to see if I qualify for 4 payments with a firm, and then a firm will run credit on the consumer, and they typically will issue, or somebody like a firm will typically issue a product that is a pay in 4 product or something like that. And what it typically requires is a 25% down payment up front, and then 3 equal payments of 25% spread out, usually over a week or 2 weeks or something like that. And again, there's no interest rates or fees associated with these. Everyone had considered these loans, but what they hadn't considered was that TILA/Reg Z wouldn't apply because there were no credit it wasn't payable in 4 or more installments, and there was no finance charge. So there was a final rule that issued on BNPL, and what the final rule said is, if you have what's called a digital subscriber account, which is basically a login, that's how many of these buy now, pay later providers create a customer profile. If you have that, then you're subject to new requirements, and those new requirements are you are basically treated for most purposes like a credit card issuer under TILA/Reg Z. So you have to provide periodic statements to the consumers, you have to engage in dispute resolution and follow those requirements. If the consumer has a dispute over a charge, you have to credit the account temporarily. So take the the item off the account or the consumer's credit while the investigation is pending and put it back on. So this rule went into effect, but there is a lawsuit that is pending its compliance. So we don't know the final outcome yet, but many buy now, pay later providers have actually already adopted many of these requirements and are complying with it. So looking into my crystal ball, I would say there's going to be more and more CFPB regulation of innovative products. And I think that the biggest thing to be cognizant of is states are going to try to regulate marketplace arrangements in ways that really regulate the fintechs, but they're really also indirectly trying to go after the banks. So do we have any questions or anything? And I suppose, Mark, we should mention if people want a copy of the book to reach out to you or me, we can email them.
Or go to chapman.com and you can download a digital version.
Yep.
Doesn't look like we have any questions in the chat.
Great. Well, thank you all for joining us, and hope that there was some kernel of something that you might be able to take. And we wish you all a great holiday season as well.